I want to thank you, everybody, for joining today's webinar on FATCA and CRS. As many of you may know, there's been a lot of news in FATCA and CRS, not just in the last year, but even over the last couple of months. There's been amendments to FATCA and CRS, and we also have some forthcoming changes, possibly in 2024, 2025, regarding digital assets and cryptocurrency. So during today's webinar, we're going to go through a couple different points. So as far as the agenda goes, one, we're going to provide a little background on FATCA and CRS, who it serves, and who is impacted, the FATCA and CRS specifics. So we're going to get into a little bit more granular detail so we could set the premise for the next part. The next part is talking about the biggest and most common issues. Our speakers will go through a list that they have, but if you want to share and care on the chat box, please feel free. And with everything that goes into implementing rules and regulations, you need the proper training and communications. So we're going to talk about that in depth as well. So I want to introduce our amazing speakers that come from four really different disciplines, but kind of intertwined. So first, I'm going to start off with Peter. Peter, if you want to introduce yourself.
Sure. Thanks, Justin. I'm a New Zealand lawyer and also admitted in the US where I now live. So I've got bar licenses in New Zealand and the US. My background is in the last 20 years, I was involved first with Baker & McKenzie, the largest law firm in the world, in its Zurich office. I then moved to UBS in Switzerland, of course, Switzerland's biggest bank, where I was in charge of FATCA and CRS implementation for its trust company. So my speciality really is how FATCA and CRS affect trust companies, but I deal with all sorts of financial institutions as well. And I have a website, gatcaandtrust.com, where you can sign up for a subscription. And I also do consulting on FATCA and CRS implementation. So that's a little bit about me.
Thank you, Peter, very much. I'm going to move on to Natalie now.
Thanks, Justin. So as you've just mentioned, my name is Natalie Dowling. I'm an operational tax consultant based in the UK with a very specialist interest in the automatic exchange of information. My background is with retail stockbrokers. I led operational taxes there at a couple of firms, both over the implementation and managing the BAU teams for FATCA and CRS as they went live back in 2014 and 2016, respectively. And I've spent the last few years working in professional services, and I now work with financial institutions of all types and sizes, focusing on the practicalities of achieving compliance for FATCA and CRS.
Great. Thank you, Natalie, and welcome. Sanjay.
Thank you. Thank you, Justin. Hello, everyone. I'm Sanjay Prabhu. I'm basically from India, but operating in UAE for the last 8 years. I'm basically a banker with 18 years of experience into banking operations, compliance, audit, and training as well. Presently, I am associated with Crow Consulting, which is one of the 8 largest audit and assurance firm in the world. And I look after their training parts as a corporate trainer. And I also look into the strategic partnership with various external agencies. So today I'll be excited to be a part of this panel and share a valuable information from the banking operations and compliance as far as FATCA and CRS is concerned.
Thank you. Thank you, Sanjay. We love your excitement. And lastly, but not least, Ross.
Thanks, Justin. Hi, everyone. I am the executive chairman of T-Consult. We're a regulatory compliance specialist, clients in 27 countries. Most of them are financial institutions. And I'm also the chairman of a newly formed trade association called the Association of Qualified and Authorized Intermediaries. So my specialist interest obviously is in FATCA, CRS, QI, Trace, DAC6, all of the things to do with anti-tax evasion and cross-border withholding tax.
Great. Thank you, Ross. And thank you, everybody. Really appreciate the background and information. So as you can tell, we have some great experience during the next hour or so. So I definitely, just to give a suggestion, sometimes we don't complete regulatory tasks on a frequent basis. And it's always important to create your own reference library of materials that you could resort to and look up anytime that task comes across your desk. So as we go through the materials today, think about, organizing your materials and thoughts based on what's discussed, so you can kind of like reduce that anxiety and stress when the task at hand comes about your desk. So with that being said, we are going to launch our poll. Okay. So support, if you could launch the poll, that would be great.
Justin, just for a bit of context for everybody, the typical thing that happens with things like FATCA and CRS is many people who attend webinars like this have a perception of what their skill level is and their knowledge level is. And it's one of the very few areas of training where if you take this poll at the beginning of a session, quite often you'll find that people give themselves a lower number at the end of the session than they do at the beginning, because they didn't know what they didn't know.
No, that is a very good point. Okay, so since we can't get the poll up, if everybody wants to put in the chat box their comfortability with FATCA and CRS from a 1 to a 10, 1 being very low and 10 being you could teach the webinar yourself and you don't need any of us. So if you want to put that in the chat box, it'll be really interesting to see. Okay, so we have about pretty moderate, some advanced, some needing additional information. Okay, so I would say it looks like experience, educational wise, is probably, oh, there we go. Okay, the poll just jumped up. So if everybody can answer that, it'll give you 20 seconds. We would appreciate it. All right, 10 more seconds. I'm legitimately counting this down. Okay, 6, 5, 4. All right, we can close the poll and post the results. So the experience is what it was in the chat box. Majority of individuals are between a 4 and 6. With some individuals below and above. So we're looking at an expertise level between say a 5. So thank you everybody for submitting your answers. Really appreciate it. And now we can get started with the webinar. So our first topic that we're going to discuss today is about a background of FATCA and CRS, again, who it serves and who is impacted. And to start the conversation off, Peter.
Thank you, Justin. Those poll results were interesting. I see that there are a number of people at the lower end of sophistication when it comes to FATCA and CRS. And I've always made it a practice when I speak on these topics to pitch my presentations to the lowest informed people in the audience, because if you dive in deeper than that, you lose those people. So for a lot of people, this introduction I'm about to give will be a refresher. You'll be familiar with it, and it may not add to your knowledge base, but I don't want to lose the people at the bottom who are just getting into the field. And so I'm going to really start at the beginning. And the beginning is we'll talk about what FATCA and CRS are and what they do, but the first issue is what problem were they implemented to address? And the problem was people hiding their money in offshore bank accounts and not paying tax on it. So imagine, if we focus on FATCA first, imagine a US taxpayer who has an account in Switzerland or Hong Kong or one of the offshore financial centers, and they don't report the income that they earn on that account to the IRS. They cheat on their taxes. And before FATCA and CRS came along, we did have, and we still do have, what Ross referred to, the QI or qualified intermediary regime, which required a certain level of reporting. But it was easy to evade that, and banks did evade it, helped their clients evade it. So there was a continuing problem with people with offshore accounts not reporting. So FATCA and CRS were adopted to address that problem. And let's start with FATCA because it was enacted first. So FATCA, of course, is short for the Foreign Account Tax Compliance Act. It's a piece of US legislation, so it's a US law passed by Congress, signed by the president, that attempts to address people hiding their assets offshore. And the name of the legislation gives away what it's supposed to do. It's the Foreign Account, foreign meaning non-US, so you've got an account outside the US, Tax Compliance Act. We want to make sure that people with these accounts comply with their tax obligations. So when FATCA was enacted back in 2010, although it didn't take effect till 2014, it was a one-way street. And what it did was it required, and still requires, so-called foreign financial institutions, in other words, non-US financial institutions, to report their US account holders back to the IRS. Very simple in concept, but not that simple in implementation necessarily. The two biggest issues, the two most difficult issues under FATCA are defining what is a financial institution that has these reporting obligations and what is an account holder. Now, in many respects and scenarios, that's very easy. We know a bank is a financial institution. So if it's outside the US, it's a foreign financial institution. And it's easy to figure out who the account holders are in that institution. But it gets a lot more tricky when you have, instead of a bank, you have, for example, a private client structure. So let's say you've got a trust or a BVI company, and that is the account holder. Then the question arises, do you look behind that? Does the bank have to look through that? Or does the client structure itself have the reporting obligations? We're not going to get into the weeds in this introduction. I just want to mention that one of the types, and the trickiest type of financial institution under both FATCA and CRS, is this type of financial institution called an investment entity. Figuring out whether your structure is an investment entity can be difficult, and then figuring out whether it has reporting obligations. Is it in fact an investment entity? Or if not, the bank then has to look through. And so is it a non-financial entity? So that's sort of a tricky area in FATCA and CRS. But the basic structure is you report foreign account holders back to the IRS. Now, initially, FATCA was a one-way street. It required foreign financial institutions to report to the IRS. And it had a couple of sticks in the legislation to try to make foreign financial institutions comply. When you think about it, why would a bank outside the US report people to the IRS? So the law had an extraterritorial effect. And the sticks that the IRS had to try to force foreign financial institutions to comply, there were two of them. One was a 30% withholding tax on US source income. So if a bank decided not to report its US account holders, and the bank had investments in US shares, for example, Apple, GM, IBM, Microsoft, then 30% of the dividends on those shares would be automatically withheld by the companies and sent to the IRS. The second stick, which has never been implemented, is a 30% withholding tax on the gross sales proceeds of assets that can produce US source income. So if you had Apple shares, if the bank owned Apple shares or IBM shares and sold them, 30% of the total sales price, not the profit, the total sales price would be sent to the IRS before the bank got the net proceeds. Again, that part hasn't been implemented, but it's in the legislation. The problem with FATCA was that as much as banks wanted to comply because they didn't want to suffer these penalties and they didn't want to divest from the US capital markets, they couldn't. They had bank secrecy laws. They couldn't simply roll over and send information to the IRS. So FATCA, as originally enacted, could have collapsed under its own weight, notwithstanding these penalties. So what happened was countries began negotiating with the IRS and with their own governments to allow them to comply. And governments said to the US, okay, we'll pass laws allowing our financial institutions to comply and report their US account holders. In exchange, we'll enter into what's called an intergovernmental agreement with you. And under that intergovernmental agreement, under some of them, some information will actually go from the US back to the home country if that home country has accounts in the US. Now, that's called reciprocity. It's actually minimal. The US gets a lot more data than it demands under FATCA. But under these reciprocal intergovernmental agreements, there was some sort of an incentive given to some countries to require their financial institutions to comply. And other countries entered into non-reciprocal intergovernmental agreements. There are two types, Model 1, some of which are reciprocal, some of which are non-reciprocal, and Model 2, none of which are reciprocal. They're all non-reciprocal. Under a Model 1 agreement, the financial institution outside the US reports to their home country government, which then sends the data to the IRS. Under a Model 2, the financial institutions report directly to the IRS. So that's FATCA, again, designed to force reporting of US account holders in with accounts offshore, whether in banks or insurance companies, or often in these private client structures with reporting obligations. After FATCA was enacted, the rest of the world said, wait a second, US people are not the only ones who want to evade taxes. We should have a global version of FATCA. And so the OECD, this non-governmental entity in Paris, came up with what's called the Common Reporting Standard. And it was based upon the reciprocal Model 1 FATCA intergovernmental agreements. Under CRS, and by the way, more than 100 countries have entered into FATCA IGAs, and more than 100 countries have entered into CRS. The US is the most notable exception. It has not entered into CRS. It doesn't need to. It has FATCA. It gets all the information it wants, and it doesn't want to provide any more information than it's currently providing to other countries. So under CRS, if you're in a CRS country, and let's just take France, and so you're a French taxpayer, and you've got a bank account in Singapore. Both Singapore and France have signed up to CRS. The Singapore financial institution will report to its home country government information about the French taxpayer with an account there, and will send that information back to France. So CRS is fully reciprocal, except for countries that don't want the data. So there are tax havens, well, I don't like that phrase, but low or no tax jurisdictions that don't want the data. There's no point. So they will enter into a non-reciprocal agreement where they'll send data but don't want any sent back. But that's essentially how these regimes work. You've got to define, are you a financial institution? In most cases, that's easy, but with private client structures, which is what I deal with mostly, it's tricky. And then trying to define who are the, quote, account holders in a private client structure, like a trust or a BVI company, is difficult. So it's basically an automatic exchange of information regime, both of them designed to prevent tax evasion. So I hope that gives at least a little flavor of what these regimes were designed to do, and the mechanics at a very high level of what they do.
Thank you, Peter. Some really good points there. And Ross, do you want to add on to what Peter mentioned?
Yeah, sure. And there was one acronym that Peter didn't mention, which is that if you are a financial institution or certain kinds of investment entity, the way that the IRS tracks all of this when they get reports is by issuing a global intermediary identification number, otherwise known as a GIN. As at this morning, there were 447,385 GINs that have been issued by the IRS to foreign financial institutions, which, as Peter says, has a very broad definition. What I think is interesting is, we on the panel and subject matter experts have to think about these things in global terms. Most financial institutions, and perhaps many people who are on this webinar, only have to think about their jurisdiction and their IGA and their domestic law in terms of what they're supposed to be doing. Whereas we have to think about Model 1s and Model 2s and things like that. So, I mean, for context purposes, of those nearly 500,000 GINs that have been issued, over half of all the GINs that have ever been issued are in 6 countries. Yeah, Cayman, Brazil, UK, Luxembourg, BVI, and Canada represent over 50% of all the GINs. So you'd argue at least the IRS knows where most of the tax evasion perhaps might be taking place in. There are 130 jurisdictions that have less than 100 GINs in them, and there are 7 jurisdictions that only have 1 GIN in the entire jurisdiction. So it's not a homogeneous picture by any stretch of the imagination. And I think the observation that I would make is very often that you have a financial institution. So if you've got a member of the audience at the moment who is working in a financial institution, their concern is, what does this mean for me at an operational level? What do I have to do? When do I have to do it? And what happens if I don't do it? Okay, so what's the control and oversight mechanism in FATCA? What is the operational requirement, which perhaps Natalie may be more qualified to talk to? And I certainly come across in our consulting environment with lots of people, and I'll speak about this later on, but the common myth that I come across, and this happens more geographically oriented to the east than to the west, is I come across more people who say, I'm not affected by FATCA because I don't have any American customers. Yeah, it's very common. And it's a myth, because actually, as Peter was saying, this is what many people would call extraterritoriality. This is the US trying to impose its anti-tax evasion rules on everybody else. Now, the fact is, as Peter also said, when CRS came in as part of the AEOI framework, hundreds of jurisdictions piled in to say, hey, this is a good idea. And that's driven mainly by tax administrations who love data. They want to get information about where their residents are putting their money, for fairly obvious reasons. So that would be my input, just to raise the issue of GINs.
Justin, if I can just comment on what Ross very helpfully just said about the GINs. It's worth bearing in mind that under FATCA, there is the possibility of a financial institution, and in fact, in some situations, it doesn't even have to be a financial institution, sponsoring another entity. Mm-hmm. And there are a couple of types of sponsorship where basically the financial institution gets a special sponsors GIN, but then the institution being sponsored doesn't have to apply for a GIN. In some cases they do, but in many cases they don't. So the number that Ross quoted of entities with GINs, there are probably literally millions of financial institutions around the world. Most of them don't have their own GINs because another entity has gotten a GIN and has agreed to do the compliance for the sponsored entity. So don't be misled into thinking that 400 and some thousand is the total universe of financial institutions that are affected by FATCA. Another thing is, Ross is entirely correct that whether or not you've got US people, doesn't mean you're not governed by FATCA. Every entity in the world is governed by FATCA. Whether there's an IGA or not, if you're not under an IGA, you're governed by the US FATCA regulations. You may not have to report if you don't have any US people. You may, because some jurisdictions require you to file with them a report affirming that you don't have any US people. But regardless of whether you have to report, you have to do very detailed due diligence to ensure that you have turned over every leaf to see whether you've got US persons. And that applies even if you have 0 US persons. And finally, something I forgot to mention under CRS, just at the publications, there is the CRS book, if you like. It's now in its 2nd edition. That's sort of the Bible of CRS that's published by the OECD. They've also published an implementation handbook that's in its 2nd edition, and they have on their website frequently asked questions that are updated from time to time. Those are all OECD publications. Very critical. CRS, as published by the OECD, has no legal effect because the OECD is not a legislature. So you always have to look, as Ross pointed out, how is it implemented locally? What does our legislation say? Have we made changes to CRS? And many jurisdictions have. It's all done at a local level based upon the OECD publications with tweaks, and sometimes significant tweaks.
Yeah, and I think that's it's, well said, Peter. I think the other, one of the impacts that happened back in 2014 across the industry, and financial institutions generally are well known to be, how shall I put this, risk averse. And so there was a swathe of financial institutions who took the approach, we don't want Americans as account holders. And so there were a couple of years when whole rafts of US account holders were off-boarded by financial institutions because they didn't want the risk of being impacted by FATCA, or rather they wanted to minimize the risk of being impacted by FATCA. And one of the points that I was just considering there is you've mentioned the 2 types of IGA market, and of course there are a number of jurisdictions which have not entered into IGAs with the US, and those non-IGA jurisdictions, the IRS covered by creating the FFI agreement, similar to the QI agreement, but the FFI agreement contains much more stringent control and oversight and enforcement rules, including things like making sure that if you have a domestic law that prevents the information from going to the US, you have to get a waiver of that law from your account holder. If you do get that waiver, that's fine. But at the end of the day, if your account holder refuses to give you the information that you've asked for about their FATCA status, then you may have to end up closing the account. So the other impact of IGAs was to a certain extent to soften the operational blow for financial institutions if you were in an IGA jurisdiction. But we had clients before the sanctions came in. We had clients in Russia, which of course is a non-IGA market, and so they were very much impacted by the very stringent rules in the FFI agreement that they had to sign up to.
Wow, we really set the tone for this session with an amazing background, purpose, and other information. Thank you, guys. Really appreciate your input. Now that we went through the foundational piece, now we're going to take the next step. We're going to get a little bit granular with an expert who actually works for FATCA. So with that being said, I'm going to turn it over to Natalie, who has a couple of slides to go through.
Yeah, I have got a couple of slides, and I'm going to just talk for a few minutes to run through the very high-level practical requirements of FATCA and CRS. So it's important to understand that different types of financial institution, different types of financial product, and depending on country to country, the responsibilities are slightly different, but the principles of what we're doing in general remain the same. And I cannot emphasize enough how much technology is your friend when implementing these processes, especially kind of in banking and broking for scalability, where you might think you only have a small population to deal with right now, but as all businesses aspire to growth, the bigger you get, the easier all this stuff is if you've automated as much as possible along the way. So as Peter and Ross have already discussed, we can broadly separate the responsibilities into two parts: due diligence and reporting. Due diligence is the bit we do all year round and is essentially the collection, validation, and maintenance of customer data, ensuring that the tax residence and the US person status of all of our account holders is accurate and up to date. The due diligence activities are summarized here. Firstly, we have collecting a self-certification at account opening stages for all new financial accounts. So when these regimes first launched, some of us didn't truly understand the scale of what was happening, and a lot of quite big firms started documenting accounts for FATCA and CRS with paper forms. This has now turned into a bit of a logistical nightmare, and for many firms, getting all that data from the forms into the systems so that it can be monitored and maintained on an ongoing basis has been quite the effort. And don't forget about your customer here as well, because an electronic journey is always going to be simpler for most customers to complete rather than a confusing, bulky form that covers all possibilities. Being able to guide a customer through an electronic journey is going to be to benefit for the customer and for the firm. So then we've got validating the reasonableness of the information provided. So you should be using all available information to do this. Anything you've collected data-wise under KYC or AML should be directly compared to the self-cert info, and also using publicly available information where appropriate. So this can help with things like entity classifications, but importantly, there is a lot of publicly available information regarding the format of tax ID numbers or TINs. Financial institutions should be checking that TINs provided on the self-cert are in the correct format for the issuing country. Again, if we use technology, this can be done quite easily. Then on an ongoing basis, firms should be scanning their book of records for what we call indicia. This can be achieved by either regularly running a search program over the entire account base, which identifies if country codes attached to these listed items here have changed since the last time you did the search. Or you can set up a system, design a trigger to a workflow item every time a customer changes their information to hit one of the indicia points, and then somebody can work through that workflow as and when they happen. The list of indicia, as I've listed them here, if these items are picked up via an electronic search, they make the account reportable under FATCA or CRS. The top three are what I like to call hard indicia. This is not a technical term. This is something I use to mean that if it is picked up by the financial institution, then it can only be cured with documentary evidence. Curing means to make the account non-reportable again if indicia has been picked up. And the bottom three I would call soft indicia. Again, not a technical term, but it just basically means that it can be cured more easily. So a reasonable explanation or a new self-certification can cure that indicia if the person underneath is not actually reportable. A good example here would be if I add a scan of my UK passport to the ID documents held by my bank, and on that passport it states that I was born in the US. We've hit a hard indicia point. Those that are born on US soil are US citizens, regardless of whether they have lived or worked there. And the bank now has to report me under FATCA, even if I refuse to provide new documentation or a new self-cert stating that I am definitely a US person. The only way this reportable marker can be removed from my account is if I present a certificate of loss of nationality, confirming that I've renounced my US citizenship and I'm solely a UK citizen now. So documents to prove that I'm not reportable. On the flip side, if I add a US telephone number to my account and there's no other indicia there, then this could be cured with a reasonable explanation, such as for business purposes, I use an international phone contract and it routes numbers through the United States. That should be adequate for the bank now to not report me under FATCA. So, guys, do you have anything to add to due diligence before I move on to reporting?
Peter, did you want to comment on CRS?
I mean, many of the things in CRS are very similar to FATCA. As I said, CRS was based upon the Model 1 IGA. So with the exception of the indicia of US citizenship and US place of birth, the due diligence is, maps almost identically with what happens under FATCA. So if that's what you were looking for, Justin.
Yep. Perfect. Thank you, Peter. Thank you, Natalie.
Sorry,
yeah,
Justin, I'm only just getting started. We've not talked about we've not talked about reporting. So on top of the due diligence responsibilities, we have the annual reporting requirement. The reportable period is the calendar year, and most countries have a deadline of May or June to submit their returns for the previous reportable period. Some countries like the UK have designed a reporting schema that allows for a combined FATCA and CRS return, so everything all in one report. But many other countries do follow the separate reporting schemas set out by the IRS and the OECD, meaning that FATCA and CRS are filed as two separate returns. For those of you that don't know, the majority of FATCA and CRS returns must be submitted in XML format. And the schemas are what we call the design rules for how the report is formatted. The format itself is not very user-friendly, especially in terms of being human readable. So generally firms would have to organize their data via another format and then use technology to convert the data into the XML schema. Some firms, usually ones with particularly large returns, may have built in-house technologies to do this for them, but lots of firms also use external managed services or licensing the technology to produce final reports. In terms of what we're reporting, as you can see here, for each reportable account, we report the account holder information and then also information about the account itself. I mean, you can see really obviously at a glance for custodial accounts, investment firms, the mapping of income is a lot more complex than it is for other types of accounts. In particular, the gross proceeds can be difficult practically implementing, as it doesn't just mean the proceeds from selling investments. It also covers any redemption style corporate event where shares have been rescinded for a payment. So as we mentioned already, the purpose of all the reports is for the international tax authorities that receive them to be able to compare against domestic tax returns and make sure everybody is declaring that what they should be in terms of offshore assets. In order for them to do that, we must provide them with enough information to match the FATCA or CRS report to an individual or entity registered in their system. And this is mainly done with the TINs and for individuals in combination with their date of birth. So in the ideal world where we've done our due diligence to a really high standard, we should have a valid TIN and date of birth for almost all individuals on the return and a valid ID number for all the entities on the return. But as we all know, managing customer data is not that easy. So when you've got kind of legacy systems and data that's pre-existing the regulations, customers that we can't get hold of and manual data processes, it means that the errors and omissions can stretch into large volumes across the reportable data. In particular, missing TINs and date of birth are a problem for the entire regime. If neither is reported against an account, then it is highly unlikely any tax authority will actually be able to match the report to a real person on their side. So it kind of renders the report useless. Substantial numbers of missing TINs on returns will trigger an event of non-compliance, especially if the receiving tax authority, after the data exchange, is not happy with the TIN coverage, they send it back, then you're probably going to get at least an inquiry, if not a penalty. This is why managing our due diligence effectively all year round is so important. And I emphasize again how the use of technology can help you achieve that. Anybody got anything to add to reporting?
Ross, did you want to mention anything about the perception of CRS in the US?
Well, the perception at the end of the day, I mean, the two frameworks, which is really, if you take them at the same level, it's not CRS, it's AEOI and the IGAs, because those are the agreements between governments. CRS is a vertical down from AEOI, which is the implementation rules for individual countries who are adopting CRS, so that when the information, as Peter mentioned, goes from a financial institution to their domestic tax authority, it's the AEOI rules that determine how that information goes to a partner jurisdiction. So the legal implication or the legal framework under which FATCA is implemented is, as Peter mentioned, is the Hire Act from 2010, the IGAs, which are at governmental level, and then how those IGAs are translated by each country into their domestic legislation in order that the financial institutions in that jurisdiction are then subject to local law that tells them that they must comply with FATCA. And the equivalent in AEOI is that the framework is set by the OECD, and jurisdictions can sign up to the transfer of information and adopt a couple of different perspectives. And to speak to what Natalie was talking about, and again, with respect to the risk aversion that many financial institutions have, in CRS, you have a concept called the wider approach. Now, typically, a financial institution, no disrespect to all those people who work in financial institutions that are watching, want to do the least possible work to comply with the regulations. And so a CRS jurisdiction may have adopted what's called the wider approach, which means that they should be collecting, as financial institutions, the tax residency information of all of their clients, irrespective of whether that client is resident in a partner jurisdiction or not. In other words, whether their information is going to be shared or not. Whereas before that, a financial institution would say, well, if you're telling me that you're also tax resident in this country over here, and that country we don't have a partnership arrangement with in CRS, we don't need that information, so they don't collect it. The wider approach, which is being adopted by more financial institutions, irrespective of whether the jurisdiction is adopting the wider approach, is just to say it's easier if we just ask all customers what their tax residencies are. Once we've got that information, we can decide whether or not we're supposed to be reporting that account based on whether our jurisdiction has their jurisdiction as a partner. Yeah.
Yeah, we should add as well that some jurisdictions have mandated the wider approach. So it is a regulatory requirement in some places for all financial accounts to have a self-cert at account opening stages since 2016.
Yeah, I guess what I'm saying is if there's a jurisdiction which is not adopting the wider approach at the regulatory and legal level, the financial institutions, generally speaking, are just going, we don't care. We're going to collect tax residency information anyway, just in case these jurisdictions join up to the wider approach later on or become partner jurisdictions.
Great, thanks, Ross. So I'm just going to move on to the last bit, which is recent and upcoming changes to reporting. So recently, we've got the IRS have issued some new rules in this year. As part of the reporting schema, US reportable accounts must have an entry to the TIN field, as opposed to CRS, where we just leave it blank in the report if we don't have a TIN. So in order to be able to report accounts that we haven't yet collected a TIN for, in previous years, we were able to put a dummy entry of 9 zeros or 9 A's into the report for any account that didn't have a TIN. In 2021, an optional requirement of providing a reason code for why the TIN was missing was put in place by the IRS, but I don't think the uptake could have been very good because of this. As of this year, they have mandated the use of this code. As Ross was just saying, kind of people will always do the minimum to make sure they're compliant. So putting something in as an optional arrangement when you really want it done is not the way to do it. You're going to have to make it mandatory if you really want it done. So the purpose of these codes will be for the IRS to be able to see more easily at a glance what stage of due diligence a reported account is up to. And depending on the volumes of each code used and how they are used year on year for the ongoing reportable accounts, the IRS will be able to get a better understanding of how successful each firm is at performing their due diligence as well. So in a similar vein, the CRS the OECD, have recently released amendments to the CRS. There is a lot going on there. I won't get into the bulk of everything that's there, but they're bringing e-money and digital currencies into scope for CRS. And there is a very hefty new AEOI initiative called the Crypto Asset Reporting Framework, which will be the equivalent of CRS for those crypto firms. But hidden in amongst all of that in the amendments is an extension to the current reportable information requirements for financial accounts that are already in scope. So it's just a couple of points here, but the work that involved in making these changes is actually quite extensive. You've got not just to change systems for extra fields or flags that you might not already be maintaining, but then you're going to have to update reporting technology to make sure those fields can be transposed into the reports. More importantly, as both of these changes are going to be giving the tax authorities that ability to look at due diligence in detail from the reportable information itself, you're going to need to make sure that your data is up to scratch, because basically there's going to be big flashing red lights on your report submissions if you're not doing your due diligence correctly. For example, if you report an account with no TIN and no date of birth, like we were just discussing, and then you've got a marker that says, actually, this is a new account and we've got no valid self-cert for it, you failed at the due diligence for that account. And if you've got multiple instances of that on your reports, the tax authorities are going to know that immediately instead of having to dig deeper as they do at the moment. And then you'll be looking at penalties and remediations and events of non-compliance, and nobody wants to do that. So, sorry, I've talked for a really long time.
No.
Anybody got any other comments around those changes?
Natalie, the only observation I would have, it's sort of parallel to the concept of what you were talking about, which is I get phone calls typically twice a month from people who've been referred to me. These are customers of banks. And what they're usually saying is, I don't understand why my bank wants this information. I don't want to give this information. It's private information to me. And I also get people who are basically saying, yeah, I can't even open an account now because there's this tiny piece of data that I'm supposed to give. And they may have mistransposed the digits in it and given the wrong data. And so there's a couple of issues there, which is, I think, and forgive me, I speak bluntly quite often to clients, to the market generally. I think banks do a terrible job of explaining why they're doing what they're doing. The most common response I see is when a beneficial owner phones me up, I spend maybe 15 minutes explaining about FATCA and about why these things are in place and what happens. And at the end of those conversations, I get the comment which says, thank you so much. Now I understand why my bank is asking me for this information. Now, whether they actually give it or not is a different question. But it just seems to me that the financial institutions are hiding behind it's regulation. You can't get away from it. You know, we have to do it, so you have to do it. You know, and there are also a lot of fintechs that are starting up in this space as well. Not in FATCA, but in you know, a lot of the financial institutions that we're seeing at the moment are more akin to fintechs than they are to banks. And there are a lot of I'll call them APIs, where people are basically saying, we're getting a tax ID number. Is there a central source that we can ping to say, is this the correct ID number, this the correct TIN for this client? Now, you can do that for a United States person because the IRS has a system in which you can query the IRS database and verify a US Social Security number, for instance. But in the rest of the world, you can't really do that. The most you can do is verify the format that's been given. You know, does the number have the right digits in the right places? You know, is it the right format? So you can pick that kind of thing up, but it's really difficult. And there aren't very many countries that have opened up their systems to be able to ping with an API and just verify the identity of the person who's trying to open the account.
Oh, thank you very much, Ross, Peter, and Natalie. That was great insight. But you know what? We're not done with this section. Because with any rules, regulations, we have to be able to train and communicate to our staff effectively so they know what they need to do and get granular enough so they could take that information and incorporate it in their roles and responsibilities. So since Sanjay's been sitting idly by for the last half an hour, it's time to get you involved. So Sanjay, from a training perspective, what goes into your needs analysis and the development of a plan based on, you know, this topic we're talking about, but also in general?
Definitely. Thank you. Thank you, Justin. First, let us understand that FATCA and CRS compliance program is a multifaceted and begins with a holistic approach. Firstly, we analyze the jurisdictional specific regulatory models, be it a Model 1 IGA, be it a Model 2 IGA, or an FFI agreement prevalent in the jurisdictions lays the foundation for the need analysis. Each of these models guides the flow of information and the reporting requirements. Let's discuss the need analysis of three models briefly. The first model, as our panelist has already enlightened us, that the first model of IGA encompasses two parts, that is the 1A and 1B. When it comes to a 1A, it is a reciprocal way of sharing the information, wherein one jurisdiction shares the information with the US, and in return, US also shares some information with the jurisdictions. And there is a 1B model, which is a non-reciprocal one. So we need to understand before going ahead with the trainings, we as a trainer or as a training institution, first we need to analyze the IGA model in that specific jurisdiction. Let me take an example of UAE. In UAE, we have around three regulators. One is the UAE Central Bank. Second is the Abu Dhabi Global Markets, which is also a regulator. We have the third regulator, which is an DIFC, which oversees the FFIs reporting to the Ministry of Finance. So all the financial entities in UAE reports to the Ministry of Finance. But here, we as a training institution or as a trainer, we need to understand the IGA agreement. We also need to understand the various regulatory recommendations given by the regulators. And as I told you, in UAE, we have three regulators. So this is one of the need analysis we do at our end in order to understand the client's needs. Second model we have is the Model 2 IGA, which involves the national government oversight, wherein FFI reports directly to the IRS. And we have some examples of countries like Austria, Bermuda, Japan, Taiwan, Switzerland, which follows this model. So again, if we are training in a Model 2 IGA jurisdiction, we also need to understand the Model 2 IGA agreement, also the recommendations or the regulatory recommendations given by the national government. And we have a third one, which is called as an FFI agreement, wherein there is a direct relationship with the foreign financial institutions who reports directly to the US. So here, in case of FFI agreement, there is no government involvement. It's a direct reporting. And we have certain countries like Russia, Nepal, who does this direct reporting. So we need to have a close collaboration with this respective financial institutions in order to understand the significance of this agreements. So I have discussed the three models. So each model demands specific engagements with the regulatory bodies and financial institutions to grasp the requirements effectively. So this is the need analysis we do at the first instance. Moving next, we examine the institution types and their services offered to US persons or the experts. Let me take again an example of UAE. In UAE, we have 88% of the population which is an experts. So you can ascertain that if it is the bank in UAE, 88% of the bank account holders will be either reporting under the CRS or the FATCA. So you can understand the huge work which needs to be completed, and also we need to allocate the resources. So let me first brief you about those four types of institutions which needs to do the reporting. The first is the custodial institutions. They normally handles the stocks, bonds, and securities. So as a training institution or as a trainer, we need to understand the custodial institutions requirement. Secondly, we also need to understand the second financial institution which reports, that is on depository institutions, who normally handle savings, current and term deposits. And along with that, we have certain non-banking financial companies as well who who accepts the deposits. So we need to consider them as well while we do the reporting. So these are the two financial institutions. The third comes is an investment entities like asset management companies who handles the collective investment schemes through mutual funds, hedge funds, or private equity funds, or a holding companies or a wealth management funds. So again, as a training institution, we need to understand the investment entities training requirements, because we cannot give one training to all these type of different types of financial institutions. And we have the fourth one, which is unspecified insurance companies who handles especially the life insurance products and not the non-life or the general. So here also we need to have a specific trainings with reference to the cash value insurance and the annuity contracts. So these are the four types of financial institutions which we need to understand the needs of these institutions. And also we have the fifth one, and the fifth one includes passive non-financial foreign entities. Here, when we talk about the passive NFFs, they are the source of their income is from the dividend, the interest, the rent, the royalties. So a separate training required for the passive non-financial foreign entities. And again, when it comes to the non-financial foreign entities, we also need to understand in which jurisdictions they are and which model they follow. For example, there might be a passive NFFE under Model 1 or Model 2 of the IG. So under Model 1 and Model 2, we need to identify the controlling person. And the law says that when it comes to Model 1 or 2, we need to identify the controlling persons who hold more than 25% controlling stake in that organization. And we have also discussed about the third one where there is no IRS agreement. And we call that as an FFI direct agreement with the IRS, like countries like Russia, Bhutan, Nepal, Sri Lanka, they are having a FFI direct agreements. So when there is an FFI direct agreements and there is a passive non-financial entity, we need to understand the law that we need to find out who is the controlling person, and there the threshold is 10%. So these are the areas which we need to understand as a trainer and a training institution before proceeding with the trainings. Now let me give you a brief about one of these financial institutions, and I will choose the depository institutions with reference to the UAE. As I informed you earlier, that 88% of the bank's account either falls under the CRS compliance or the FATCA compliance. So we as a training institution needs to create a trainings at 3 levels. The first, we need to understand the corporate governance structure of an entity. And most of the banks in UAE are listed ones. So they have well-placed corporate governance structure. So first, we need to train the board and senior management level trainings. Second, we need to train the responsible compliance officers and the task force team of the compliance department. And third, we need to train the frontline employees, which includes the relationship managers and also the outsourced agencies like direct selling agents. So these are the 3 levels of trainings. Let me cover some of the areas that we need to cover under the trainings to the boards and senior management. As you know, there are certain organ banks or financial institutions who are operating more than 50, 70 or 100 years. They have millions of accounts or the database. And you know, earlier we did not have computer systems. Everything was captured manually. And identifying who is the person who we need to report under the FATCA or CRS is a big task for a big or large banks. So we need to have a temporary FATCA steering committee at the board level. So we do provide a trainings of 1 hour or 2 hour sessions to the board and senior management on conducting or having a FATCA steering committee, which plays a crucial role in compliance, in preserving the institution's integrity and the reputations. So board needs to have a temporary steering committee to see that the things are implemented in a holistic approach at an enterprise level.
Yeah,
Second
Sanjay,
area, yeah, please.
Yeah, no, I definitely agree with you.
Yes.
The components you spoke about are, a good structure to operate in. With the remaining time, since we went through a lot of background information on FATCA and CRS, it's now time to put it in real life terms. So we're going to go through the biggest issues that our experts have seen recently, and I'm going to start with Peter. So Peter, this is a lightning round. Let's kick it off.
Sorry, what is the question? I'm not quite sure what your question is, Justin.
The biggest and common issues that you've been seeing.
Well, I think the commonest issue that I'm dealing with almost on a daily basis now, because I deal with private client structures primarily, is how to classify these structures. And what I'm seeing is that banks take an ultra-conservative approach, and the fiduciary that provides the private client structure, or the client himself, has a different view. And since I'm representing mostly the fiduciary institutions, I'm at loggerheads a lot with banks as to how to classify the entities. I think banks forget, and other big financial institutions, that it is not their job to classify their account holders. It is their job to make sure that the self-certification that on which the classification is specified is not, well, I can't remember now off the top of my head the exact words, but it's got to be reasonable. But they don't get to classify, they just get to sort of probe to make sure that it's not reasonable. And I'm fighting constantly with banks who think they have to classify it. And if there's a disagreement with the bank, then sometimes the banks just dig their heels in, and they're just dead wrong. I just had a case recently where I had to go to the top of the head of the Swiss regulator to rein a bank in because they were taking an absolutely illogical position. That's what I'm seeing as the biggest, the classification of entities.
Thank you very much, Peter. Ross, what are you seeing out there?
Yeah, you asked me to figure out 5 things. I've got a myth to bust, an opportunity to raise, a perspective, an issue, and an attitude. Okay, first of all, the myth that I mentioned earlier on is financial institutions thinking they're not subject to FATCA because they don't have Americans as clients. And that's just a myth. It's not true. The opportunity is, and I've spoken about this many times, is back in 2014, there was a wholesale offboarding of American account holders. Question is, where did they all go? Yeah, the opportunity, and I've spoken to many banks about this, is, and we didn't cover it earlier on, which is when you're thinking about FATCA, it doesn't matter whether the US person that you onboard trades the US or US trades in US securities or not. They're going to be reportable because they're American, not because what they do. And so everybody is talking about reporting in FATCA, and that's irrespective of where their money is coming from. But there is an overlap, which, Peter was kind enough to mention, one of our specializations is in QI. And the overlap is that if you have an American that does trade in US securities, you have additional problems to solve. You've got the potential for backup withholding. You've got the potential for 1099 reporting, 945 reporting. So it looks from the outside like it can get really scary really quickly. And that's one of the drivers for why people have offboarded Americans. But there is a trend going on out there where people are trying to go, but hang on a second, if we could block the American from trading US securities, then they're just an American account holder that we would report every year. In FATCA, that would be it. So there are some people out there who are trying to figure out how to have a product which is allowing Americans to have account holders, simply by blocking them from trading in US securities or in derivatives that have underlying exposure to US securities. The perspective is, and I think both Natalie and Peter have talked about it a little bit, there is a big difference in FATCA between having an entity as a client and having an individual as a client. An individual, FATCA is Chapter 4 of the US Internal Revenue Code. So you can derive the Chapter 4 status, the FATCA status of your account holder, if they are an individual, simply by using their KYC. You don't have to have W-8s or anything like that, although many do. What becomes complex is when you have a client that's an entity. And that's where there are so many different types of entity within FATCA and also in CRS that you really can't get away without having something like a W-8 BEN-E to be able to make sure that the person who is telling you what they are has done their own due diligence to understand whether they're an active or passive NFFE, for example. And I would make the point to support what Natalie was saying and Sanjay. In linguistic terms, there is a big difference in language. Okay, an NFFE in FATCA is not the same as an NFE in CRS. There are subtle differences in the way that those two entities are dealt with. And so very often I start off by having to teach people language before I start teaching them about the regulations. One of the issues that I mentioned is called COPA. So all these financial institutions, when FATCA came in, had already got a whole pile of account holders. And the IRS had a system which was a certification of completion of due diligence on pre-existing accounts. Now, everybody should have, that was required to, should have made a certification under COPA by the end of 2017. I can tell you, I think there are financial firms out there that still haven't filed a COPA certification that should have. And finally, it's an attitude. And the attitude comes from the fact that the financial services landscape that we have today is moving towards fintech and AI much faster than the traditional custodial banks are moving. And those fintechs have a simple philosophy. They want it fast, good, and cheap. And the problem is you can only have two of those at the same time. Yeah. And so a lot of fintechs that we see are basically doing everything online, and they have a single tick box on their system that says, I am not an American. And if you tick that box, they think they're done. They think they've fixed FATCA. And that's just not true in many cases. And so, yeah, that's the attitude of the industry has to change. And much of it has to do with the attitude to compliance. Is compliance important? I can tell you that there's a very big difference in attitude between compliance in Asia than compliance in Europe, for example. Yeah, so in Asia, it does tend to be tax ops rules. Yeah, if the operations team want to do it one way, compliance doesn't have quite as much power to be able to say, no, you can't do that because the regulations say you can't. In Europe, there is very much an orientation towards the importance of compliance. Nobody wants to trip over the regulator. So that was a really fast approach to 5 issues that I see out there.
Yeah, I mean, that was a good list. Thank you very much, Ross, for the input. And thank you, Peter, as well. But we're not done yet. Now we're going to talk about some common reporting issues. And on tap for that is Natalie.
Yeah, I'm going to be quick, Justin, as I know we're kind of running short on time. But most common problems, I speak to the regulators a fair bit as well, and so there's information about issues they see commonly popping up actually in the reports. The biggest one, number one, is the incorrect understanding of the term undocumented. So undocumented, and I think this probably comes from a little bit of the QI regime and stuff like that, and maybe just the way it sounds. it does not mean that you don't have a self-cert for an account. And a lot of financial institutions think if we do not have a self-cert, then that account is undocumented. And then there's a marker on the report itself that's got a flag. If you mark that marker on the report, it actually means that you have no idea where this account holder is resident. So the technical term within the CRS means that you do not have the permanent residence of this person. There's a hold mail instruction or a care of instruction only and no other addresses. So that basically throws your data out. It makes the tax authorities are looking for something else when that's not the case. So people should review that and how they're using that term. Biggest other problems are excluded accounts and excluded persons being included on the report. So excluded accounts, tax wrappers, pension accounts, things like that. I think some firms have taken too all-encompassing an approach and just gone, I'll report every account that person's got when actually only one of them needs reporting. The other thing, joint accounts reported as entities. So some people have misunderstood the requirement. It says a joint account, just Mr. and Mrs. or a couple of friends that have got something together for an investment club or something like that. These are not entity accounts. These are individual accounts with more than one holder listed against them. And joint accounts should be reported as individuals, not as an entity like a company or a trust, as Peter was talking about before. And then alongside the missing TIN and date of birth stuff that I was talking a lot about before, using default information. This is a really big problem as well, because if a lot of times when there's missing dates of birth in people's systems, stuff like that, it will put a default in because the data field itself can't be empty in the system. 1st of January 1900. I mean, we look at that and we know that it's very unlikely that your account holder is 123 years old. But putting in defaults instead of just clearing out the information and reporting nothing confuses the data on the tax authority side. So if I've reported the correct TIN, but then I've reported a default date of birth, the tax authorities can't match those two things up together. So they'll be like, we think it's this person, but the date of birth doesn't match what we've got on file for that person. So they have a fuzzy match instead of an exact match. If you leave that date of birth off, if you know it to be incorrect, don't report it. So if you leave that off, then they can go, oh, well, we've only got the TIN and the TIN matches and it matches their name. Great, we've got a match, instead of fuzzying that matching process by the inclusion of default information. So yeah, in a nutshell, I think they're probably the biggest issues we see in the physical reports.
That's a good nutshell, Natalie. Thank you very much. And thank you for everybody's input. So what we're going to do now is we're going to begin Q&A. We have a number of questions submitted that we're going to go through right now. And if you want to add to our list, please do so in the Q&A box. The first question from an anonymous attendee. There are some FFI did a de-risking by not opening accounts for U.S. persons. So how the IRS will act for that, since it's a disadvantage for FATCA law. Who would like to answer that question?
So I think Ross has covered a little bit of that already. There are also, in the update that I was referring to, that's mandated the use of these missing TIN codes, it does kind of reiterate that we shouldn't be closing accounts of US persons just because we don't want to deal with all the due diligence that goes alongside it. And as Ross kind of mentioned before, a lot of the time, even if we say we're not going to have US persons anywhere near our product and stuff like that, if you're following all the processes correctly, you will find US persons in there or US indicia in the pool. So you end up having to perform that follow-up activity anyway, even if your intention was to not have US people anywhere near your product. So the best approach is to kind of sit down and assess the responsibilities, the requirements, and crack on, I think, rather than trying to find ways of getting the US people out. Just accept the fact that you have to deal with these regulations and find the best, most effective way for your firm to do that properly.
I think, Natalie, the other comment that I would make there is that, I do come across people who say, oh, we found US indicia, so we closed the account. And I said, that's not the point of FATCA. The point of FATCA is if you find US indicia, you have to attempt to cure that indicia. Yes, you have to find out why that indicia exists. And in many cases, you'll be able to cure it. That's where you end up with, I've got a US person that was born in the United States, but left the United States just after they were born. So they didn't get a social security number. But they left the United States perhaps because their parents took them out. And this happens a lot in Malta, for example. There's a very large population of people who were born in the United States, but were brought back out very soon after birth. And the problem is that the rules in the US law basically say, if you're a financial institution, you'll need to get a certificate of loss of nationality. And that process costs money and is quite complex to go through. And so you end up with the financial institution caught in the middle, basically saying, well, you've got US indicia, it's hard indicia. Do you have anything that would cure that for example, a certificate of loss of nationality? The person says, no, I don't. So now you're into, well, we need your US social security number. You've told us you were born in the US. Well, I don't have a US social security number. I've never been in the United States other than when I was born. I was taken away from the United States within days. I've had no connection with the US ever since. And you've also got people like the Association of Accidental Americans, who have spent many, many years fighting against FATCA on the basis that the European Union is breaching European Union law when financial institutions send information about accidental Americans to the IRS. So there are other forces at work here. The only other point that I would make is the foundational concept here is the US is one of two countries in the world that taxes based on citizenship as opposed to residency. Yeah, those two countries are Eritrea and the United States. Okay. Every other country in the world taxes based on residency, not on citizenship. Now, there is a lady in New Zealand who is a US expat that has made an application to the IRS under what's it called? It's the Systemic Advocacy Issue System, SAMS. And she's been given a case file number by the IRS because she's made the point, wouldn't it be easier if the US moved from citizen-based taxation to residency-based taxation? Then it could join CRS, because CRS is residency-based, whereas the US is citizen-based. Now, the fact is, it's highly unlikely that's going to go anywhere anytime soon. But the IRS has written to her, and she's been in communication with me to say the IRS has said this is worthy of being elevated up the chain to the US government and to Congress as being something that should be talked about. And whether the AAA manages to get its way with the European Union because it's trying to say that the transfer of data to the US is illegal under GDPR, I think has very little chance of succeeding. So the net result is people are trying to get away from FATCA. I don't think there's any easy way of doing that. Just get on and comply.
Can I just add a couple things on the Eritrea situation? As I understand it, Eritrea imposes what's called a solidarity tax based on citizenship, but not their entire income tax system. That's what I have read, in which case the US is the only country in the world which bases its entire income tax system on citizenship plus residency. So it's not just citizenship. So also I want to just point out, if you don't have a US Social Security number, you're one of these accidental Americans, it's very difficult to get one. Very, very difficult. It's not as if you can just apply and get one. So you've got these people that are caught in a really difficult situation.
Okay, great. Now we're going to go through a very shorter question. Question from the audience. How long are self-certification documents valid?
3 years from the end of the year in which they were signed, if you're talking about W-8s.
So technically, I think a self-certification form, rather than an IRS W series form, is valid indefinitely until a significant change of circumstance invalidates it. But and for self-certification purposes only, that also stands for the W series form. So if it was an individual W8 Ben or a Ben E, and it wasn't for the purpose of documenting them for QI, for US income receipts, it's just for a self-cert. The same would be, you'd be able to rely on that self-cert until a significant change of circumstance.
Great. Thank you, Natalie. I believe this was mentioned, but I'll bring up the question anyway. For individual new accounts, is date of birth required in CRS?
Anybody else? So I think the requirement is that you need to report, in terms of a self-certification, a date of birth doesn't need to be on there. But if you're collecting dates of birth as part of KYC and things like that, then you should be including it in the reportable information. I think the rules slightly differ on FATCA and CRS in terms of reporting, in that the IRS say if you're not reporting a TIN, then you must report a date of birth. Where CRS is telling you to report all the information that you've got available. Hopefully that is a TIN and a date of birth, because as we said before, that's the matching information that they use to identify that person on the other side.
Just one other thing,
All
now, just going back to the issue of validity of self-certs. I agree with what you said. I think from a practical perspective, most financial institutions, when they're looking at it, don't want to have bifurcated systems. They don't record why they're collecting a W-8. And so the validity from a QI perspective, so if the client is likely to be receiving US sourced income and or they're trying to claim a treaty benefit, then it's 3 years from the end of the year in which it was signed. But I agree with you, if they're only collecting it for Chapter 4 purposes, then it's just, until there's a substantial change in circumstance. I haven't found a financial institution yet that basically records why they collected the W-8. They take a very simple approach to things, which says the W-8, 3 years, end of story. We just renew them every 3 years.
I think you just got to be careful there. If you're not actually performing QI activities and you're using the W-8s as self-certs, then you're going to be really annoying your customers asking for a new one every 3 years when you don't actually need to by the regulations.
Banks don't mind being annoying. That's been my experience. And also, I've also seen them request CRS self-certs every 3 years too, even though they're not required to. So it depends on the institution. But
and you've also got
the
OECD trace framework, which has a self-certification in it, and that self-certification has been implemented in Finland at the moment, and that has a 5-year validity.
That is kind of for QI purposes as well, though, isn't it? It's to give
under trace, yes, it's for claiming treaty benefits.
Okay, great. Next question, an individual that needs a little consoling. Is there any acknowledgement from the IRS as to how painful the series review process is? Chapter 4 withholding is now far too common due to issues in getting custodian validation on forms.
My observation here is, and I'm happy to console the questioner, but my observation is that Chapter 4 withholding isn't really that common. It's actually quite rare in circumstances. It's often performed by an upstream financial institution on one of its clients, simply because they failed to tick a right box on a W-8 IMY or something like that. The irony being then is that all the income is penalized, even though it may only be 1 or 2 customers that created the problem in the first place. To speak to the IRS, I mean, the IRS has had several congressional presentations where it has made the point, because the logical question is, if FATCA was working, why has the IRS not released information to say how much tax has it regained that it would otherwise have missed? Yeah, and the congressional committees are focused on FATCA withholding, but FATCA withholding is not tax. It's a penalty for not doing something correctly. Yeah, the question is how much more tax has been created because the IRS was able to see the dots and say, well, this US person has an account at this bank, but they haven't declared that on their FBAR report. That's potential tax evasion. We go after them to see where we can get more tax. And the IRS has said that, that their information is they haven't really been able to implement FATCA at that level because they're underfunded and under-resourced. So, there are big questions in the US about whether FATCA is doing what it's supposed to do. Not that that will affect anybody outside the United States, because you still got to do what you got to do.
All right, thank you, Ross. Natalie, another question from Catalina. What about persons with dual citizenship? Also, what about the tax treaties between the U.S. and other countries?
I can tackle that one. Dual citizenship for FATCA is irrelevant. If you're a US citizen, it doesn't matter if you have any other citizenships or not, you are a US person. And there's no treaty that breaks a US citizenship nexus. In terms of other situations where you have dual residency, actually, this is one of the amendments that's coming to CRS, which will be implemented no sooner than 2026, with first reporting under the new rules in 2027, depending on the country. But that's the soonest that anyone anticipates them. Under the new rules, under the old rules, the current rules, I should say, under CRS, if you were resident in 2 countries, but under a treaty, you were treated as resident in just one of them, you can report just that residency for CRS purposes. That is going to change under the amendments, where you're going to have to report both of them, and you can no longer rely on treaty tiebreakers. Also, under the amendments, there are going to be new rules around if you're resident in a country with one of these, what the rules describe as, I can't remember the exact word, but it's something like problematic residence by investment or citizenship by investment schemes. You're going to be having to provide more information about your actual residency and whether you obtain residency under one of those programs. So they're really, CRS amendments are really buckling down on claims of dual residence and residence under these other programs.
And I think, Peter, there was another question about thresholds somewhere in the chain that I saw, and I responded to it just by saying that, you know, the thresholds are there because the IRS is basically saying, look, if you're an American, you've got an account overseas and you've got less than $50,000 in it, the chances are it's a low risk for tax evasion, and therefore there are certain benefits you gain in terms of due diligence. And the sort of the same thing applies when you look at the attitude of the IRS, that they do seem to be focused on saying low value accounts are unlikely to be used for the purpose of evading tax. You know, so that there's usually a benefit to be gained there.
Yeah, but the low value accounts, it doesn't apply to all types of accounts. It's only depository accounts, right?
Yeah.
And I don't remember off the top of my head, it's either new or pre-existing that it applies to, not the other. So even there, you've got not a carte blanche threshold.
Yeah, and of course the other thing is, you know, how do you avoid FATCA and CRS? And you know, the European Union's come out with DAC 6 as a directive, which essentially is trying to catch people who are trying to evade CRS by providing a whole set of hallmarks, which are completely different from the kind of thing that Natalie's been talking about, which is mainly tax operations, and is more to do with the qualitative nature of arrangements that people go into. But I guess the point I'm making with respect to what you were saying was, if you've got people who are gaining residency or citizenship by investment, my argument would be they are much more likely to be facing the possibility of being tax evasion subjects, simply because they've got enough money to invest in a foreign country to gain citizenship. So, you know, from a regulatory viewpoint, I would look at those and just go, yeah, I'd take another look at those, because they are more likely to be evading tax than somebody who just has a trading account at, you know, BNP Paribas or Citi in France.
Great. Well, I really want to thank everybody for participating today. Your insight, your experience was just overwhelming. I need to take a break after this based on it. But for everybody who attended, you know, thank you very much for attending. Hopefully you were able to build your reference library throughout the session, but we do have 2 takeaways. One, We are going to send a follow-up with some resources, some FAQs and other information. We want you to go home happy. And then 2, if you're interested in our GCI, FATCA, and CRS specialist programs, you can get a 20% discount. And if you are interested, it's in the chat box, but you can email GCI at info@GCI/ -CCM.org. Let me repeat that because I got the hyphen wrong. info@GCI-CCM.org if you want more information and plus the 20% discount. So, my panelists, that was exquisite. Thank you so much for the time, for the preparation, and everything else. It was a pleasure having you today.
Thank you, Justin.
Thanks, Justin.
And thanks to our audience.
All right. So,
Thank you, everyone.
yes, thank you, audience. Obviously, if it wasn't for you, we wouldn't be here today. So thank you very much. And if you have any additional questions for any of the panelists, please reach out and we'll give you their contact information when we follow up. So thank you again, and I wish everybody a great day.
Thank you.
Thanks,
Bye-bye.
everyone. Goodbye.
Bye.
Take care.